Well, the International Monetary Fund has stated in its latest forecast released on Friday that global growth is holding steady. Global growth is projected at 3.3% both in 2025 and 2026, below the historical average of 3.7%. The forecast for 2025 is broadly unchanged from that in October 2024 World Economic Outlook, primarily on account of an upward revision in the United States, offsetting downward revisions in the other major economies. Let's take a listen.
In our latest projections, global growth remains steady at 3.3% this year and next, broadly aligned with world potential growth. Inflation is declining to 4.2% this year and 3.5% next year in a return to central bank targets. This means that the very large global disruptions that started with the pandemic, the war in Ukraine, and triggered the largest inflation surge in 40 years are behind us. This is the end of a cycle and the beginning of a new one. While the global outlook is broadly unchanged from October, divergences are widening. Among advanced economies, the United States is stronger than previously projected, expected to grow at 2.7% this year. By contrast, growth in the euro area is revised downwards and will increase only modestly to 1% in 2025, reflecting low consumer confidence and the persistence of high energy prices, especially relative to the United States. Elevated trade policy uncertainty will contribute to anemic demand in many countries, including China, where we project 4.6% growth this year. Some of the divergence is structural. For instance, the US experienced persistently stronger productivity growth than Europe, especially in the technology sector, linked to a favorable business environment and deeper capital markets. Among emerging economies, potential growth has decreased for China, in line with secular and demographic trends, but it has increased in other emerging markets, and the two are now comparable. Turning to the risks, economic policy uncertainty is elevated, with likely policy shifts from many newly elected governments in 2024. In the near term, risks could exacerbate divergences between countries. The euro area could slow down more than anticipated due to weak momentum in manufacturing and fiscal vulnerabilities in some countries. For China, the risks are also to the downside. The economy is at risk of a debt deflation trap, and the decline in Chinese government bond yields shows rising investor concern. Both for the euro area and China, this could lower activity and inflation. For the US, many of the uncertainties originate with potential policy shifts under the new US administration. While these are hard to quantify precisely at this stage, we would categorize them as follows. First, there are demand-stimulating risks, such as a further fiscal stimulus or a confidence boom fueled by expected deregulation efforts. These would increase output and inflation in the near term. There are also supply-constraining risks, such as higher tariffs or curbs on migration. These would weigh on output, but also add to price pressures. The combined effect on output in the near term is uncertain, but likely to the upside in our assessment. Any combination of these policies, on the other hand, is likely to add to price pressures in the US. Higher inflation would prevent the Federal Reserve from cutting interest rates as initially planned. These policies will also likely strengthen the dollar and tighten financial conditions elsewhere, especially for emerging market and developing economies. In the medium term, the risks are more uniformly to the downside. Curbs on migration and protectionist policies will weigh on potential output. The initial positive effect of a fiscal expansion will wane, and the associated increase in public debt could lead to fiscal vulnerabilities further down the road. The increase in US long-term yields, despite the Federal Reserve easing, reflects some market nervousness about future fiscal policies. Deregulation could boost output by removing red tape and spurring innovation, but it could also increase financial vulnerabilities. Another risk is that renewed inflation pressures so soon after the recent episode could de-anchor inflation expectations as people and businesses have become much more vigilant. Indeed, we see that near-term inflation expectations have increased above central bank targets. Turning to policies, given this environment, central banks should remain vigilant and be ready to act forcefully if inflation were to break out again, while also monitoring carefully the buildup in financial risks. Second, fiscal buffers need to be restored now, and countries need to do so in a way that preserves growth. As history teaches us, delaying needed adjustments in a low-growth, high-interest rates environment can trigger market loss of confidence that would further add to fiscal pressures. In addition, countries should continue to seek ways to improve growth by focusing their efforts on ambitious structural reforms that will help better allocate resources, increase government revenues, foster innovation and competition. On that front, it is also important to preserve and improve our multilateral institutions to help unlock a richer, more resilient and sustainable global economy. On the de-anchoring inflation expectations, let me start by taking a step back and reminding everyone that one of the great achievements in that inflation episode we're just coming out of is the fact that inflation expectations remained very well anchored in most countries in the world. And as a result, this helped the disinflation proceed fairly quickly and aggressively. And so central banks were able to rely on the credibility that they had accumulated over the years and convince households and businesses that they would not let inflation run away, and that really helped contain inflation pressures. Now, the danger is some of that capital may have been eroded, if you want, that credibility capital may have been eroded. And if we were to have a new sequence of increase in price pressures, which again, as I explained, is not part of our baseline, it's under some of the risks that would be associated with maybe some expansionary policies in some part of the world or some supply constraining policies, then that capital may be eroded. And as a result, households, people, businesses may be very, very cautious and very reactive in adjusting their prices and their inflation expectations going forward. That would make the task of central banks much more difficult. On your second point on the stronger dollar, if you have a combination of policies that leads to stronger activity and a resurgence of price pressures in the US and leads the Federal Reserve and maybe other central banks to delay their easing cycle, then that will attract foreign capital, that will strengthen the dollar, and that will, in doing so, that will put pressure on the rest of the world. Many countries, especially emerging market economies, but we see that elsewhere, have imported goods that are priced or invoiced in dollars. A stronger dollar means higher prices for these goods. It means higher domestic inflation pressures.
So we did, as you noted, we revised down our forecast, our growth forecast for Egypt in 2025 to 3.6 and in 2026 to 4.1. And this is respectively 0.5 percentage point and 1% percentage point downgrade. The reason for that is we do see a weakened confidence in the middle of foreign exchange restrictions and shortages.